Hey, when it comes down to your life insurance, are you properly protected? Do you have enough coverage to take care of the responsibilities of the life after death for your family? See, there's a simple analysis that we utilize that the wealthy people do to make sure they properly protected. It's called the DIME method, all right? 4 key areas that we look at to make sure you properly protected. The D stands for death, the I stands for income protection, the M stands for mortgage/debt, and the E stands for education. The death benefit, funeral expenses, is about $15,000 national average wide, so we make sure we put that in there. We jump down to the E, education. When your child is 11 or younger, we set aside 40 for them. When they are 12 or older, we set aside 60 for them. 40,000, 60,000, all right? Because we want to put them in a position to have some college savings so they don't have to become best friends with Sally Mae like I had to. Sally Mae was calling me during the pandemic, asking where their money was at. So we want to make sure they have some type of money. It's college savings. We put that in a mutual fund, let it gain interest, all right? Then the mortgage. If you got a mortgage, right? If you're the breadwinner of the household, wouldn't it be wise to pay off the house so the surviving spouse don't have to deal with that? So they have a house that they could stay in. What would it look like? You at the pearly gates of heaven. You jumping up and down for joy because you going to heaven and your family getting kicked out. Your family getting evicted out the house that they are used to living in. So we want to pay the house off. And then what debt do you have that will put liens on the house, liens on the different assets that need to be taken care of? We're going to wipe out all the debt as well. And last but not least is the education. The income protection. Income protection, all right? Income protection, see, here's the thing. You want to put yourself in a position to protect your income if you pass prematurely. So check this out. The question becomes, how much of your income would your family still need to come in as if you're still there to keep the lifestyle running as if they're still there? They say they need about $2,000. Well, here's what we do. For every $1,000, we add $100,000 in protection. We had $100,000 in insurance, so that $2,000 would turn into $200,000. All right? Put that in the interest-bearing account. Let that account act as a trust. See, trust is something that loved ones put together for their family members, all right, when they pass away. So they can leave a monthly check to their loved one when they die. All right? So that next generation or the people that they're giving it to, they blessing with, can get ahead in life. So now that interest-bearing account kick back a check for about $2,000 a month without touching the principal of the $200,000. See, this is how we create wealth. This is how we transfer wealth. All right? So don't you want to be in a position to leave an inheritance and not a headache? Right? So I ask you, how much coverage do you have? See, if you do the DIME method and you got a $50,000 policy and they say you need $500,000, that will be devastating for your family if you pass prematurely. So we want to get that taken care of so your family is put in a position where you can make sure that an inheritance is left to them as opposed to a headache. So let's make sure we get that set up. Keep pushing, keep striving, keep going for greatness because you are great.